I'm Edward Marten, the CEO of QuotedData, a news and research firm serving professional investors, but also private investors. My background is broking equity stories to fund managers, so I understand investment strategy, what stock pickers like to buy and sell, and how they do it. Before we go into the topic, if you were here last year, you'll remember we discussed fund structures and how they suit different investments and different investment strategies. And we concluded that all structures, including ETFs and open-ended funds, had their place for different things. But investment companies were particularly useful for illiquid investments, such as property, and for managers that wanted to use the extra freedom that this structure allows. We illustrated this case for meeting managers managing equity funds, a fund of funds, and a renewable energy fund, owning things like wind turbines and other energy projects. We focus on this unsung hero of the investment world, investment companies, and explain how they have independent boards who try to make sure investors are getting the most from their fund manager, that they can borrow at times when they think sensible to enhance returns, and do interesting things to smooth out returns, which Dan actually can touch on later. Also smooth dividend payments to investors and try and keep them consistent. We looked at the size of the investment companies market, which is still the largest equity sector by number of companies by some way on the London Stock Exchange. At the back of the newspaper, you often see a list of LSE listings, and you just a large chunk of that is investment companies. It's quite sizable and relatively unknown. We also talked about new issues and recently have come from that have recently come from investment strategies that are popping up, and we discussed how they grew them. We've updated these slides for this year, so you can pull them down off the Master Investor website after the show, and you can see where the performance and underperformance has come from. So hopefully last year's slides will be there also. But just quickly, this is a little summary which you can download, and this has all been updated, so you can see the new IPOs, new capital raisings, the 22 new issues, and this amount of money raised last year was staggering. You can see the growth in assets, and the number of funds is quickly rising. So it's actually, there's a lot of money pouring into this area, and then for good reasons, taking advantage of the structure. So you can download that, and you can see the performance updated. And you can see the discounts have actually just are slightly wider at the moment, potentially offering value. And this is today's panel. And of course, yes, remember you can download that from the Master Investor website. For this discussion today, however, I'm really excited to be introducing this year's panel. For this discussion, we'll talk about direct investing in stocks and how these guys go about investing in them and deploying their investment strategies. As you know from your experience, it's so important to spread the risk, but true diversification of risk is quite hard to achieve without some fund exposure. Also, there are many different ways of picking stocks that will make you money. So we'll also talk about 3 different funds with different investment strategies and look through their fund manager eyes to see how they go about deploying their investment strategy. I have chosen this panel for their excellent performance track records. In a world where it feels like robots are taking over, they are stock pickers like you. I don't want to focus on passive funds, trackers, index-linked funds, where the focus is probably on index weightings and costs. I feel it would be much more interesting to understand how decision-making works in an active portfolio management with real people, which we can all relate to. Let's see how the pros stick to that course on what can be a stressful and emotional roller coaster. Firstly, we'll offer some insight into a few strategies, and then over the course of the session, we'll go into the timing, when to buy, sell, and hold. To help today, we have what I think are, sorry for the Top Gun quote, best of the best. In absolute return, growth, value, and income, with CG Asset Management's Chris Clothier, BlackRock's Daniel Whitestone, and Polar Capital's Nick Brind. Chris is from CG Asset Management, until recently one of the best-kept secrets of the asset management world. It's a small partnership with the best long-term track record of the trust world, with their flagship fund, Capital Gearing Trust, being the best-performing investment trust over 30 years. It's only lost money 1 year due to a currency move, which was down 2%. Also, they've just reopened their open-ended CG Absolute Return Fund. Dan is from BlackRock, the largest, well-resourced asset manager in the world. He manages Throgmorton Trust, which also has a long-term track record to die for, from investing in UK small and medium-sized companies. The fund is differentiated by having an interesting risk management tool in that up to 30% of the exposure of the trust can be in CFDs, offering long and short exposure. Currently, Throgmorton Trust is the best-performing vanilla growth trust, looking at small and medium-sized UK companies over 1, 3, and 5 years. Dan also manages a range of other funds, including a hedge fund, and I think is one of BlackRock's rising stars. Nick is from Polar Capital, one of the fastest-growing asset managers, which has some interesting specialist sector strategies. They are not scared to go against the crowd, often looking for contrarian ideas. Nick manages Polar Capital Financials Trust, which was launched in 2013 and is a steady pair of hands in financials, which is the largest equity sector in the world and the fastest growing dividend flow. The investment trust has low fees in its peer group and is the best performing trust in its peer group over 3 and 5 years. Thank you very much for coming, guys.
Morning.
Can you explain a little bit more about yourself, the key funds, and what you do, please?
Yeah, very happy to. So, as Ed was talking, I co-manage a global financials trust. So, global financials, biggest sector globally, covers banks, insurers, real estate, stock exchange, asset managers, and so forth. And it's very much the contrarian trade of the moment. It's probably the cheapest sector in the market, on a big discount, 35, 40% discount for some of the stocks. And you're investing in companies like JP Morgan, Bank of America, ING groups, the big Dutch bank, Direct Line here in the UK. And it's giving an exposure globally to financials. Attractive income, about 3.5% yield, and returning a lot of capital to shareholders at the moment. So that's it in a nutshell.
And Dan?
Great. Morning, everyone. So Dan Whitestone. I run the Throgmorton Investment Trust. It's outperformed its benchmark by 6% annualized over the last 5 years and has a real focus on finding great growth investments that can compound their earnings and their returns over many, many years. I also run 2 hedge funds, an offshore hedge fund and a UCITS hedge fund. My Cayman hedge funds delivered 12% annualized net return since inception. Again, we're a very strong growth bias, very long-term focus, but really prosecuting industry change and disruption, which I'll give a presentation on later. Whatever fund I run, very strong growth bias, and all my funds can short shares to profit from those that fall, as well as benefit from those that can go up over multiple time periods.
Good morning, everybody. I'm afraid I'm a total imposter here because the track record of my trust is based on my partner, Peter, who started investing in 1982. If you'd started with him then, you'd have made 220 times your money. I joined the firm a few years ago, and I've tried not to damage the track record too much. What we do is we try and deliver what we call absolute returns. And so we're really focused on not losing money, and then we hope that the upside will take care of itself over time.
Thank you. Three very different investment minds and approaches. I'm very keen to explore what you have to say about your investment strategies. So let's start. Let's get under the bonnet of value, income, growth, and absolute return investment strategies. Nick, value and financials has not been the top of the chart since the financials crisis. We are now 10 years since that event in a market that seems overpriced. Are you still finding value and attractive income, and how do you look for it?
Yes, great question. If you bought a basket of bank shares 10 years ago, you would have made 3 times your money. Yet despite that, you've underperformed the market. So despite all the headlines, around the banking sector, it's actually incredibly profitable, generate good returns, rising dividends to shareholders, and remains very, very cheap for obviously reasons going back 10 years ago. And how do we go about picking our stocks? It's going back to remembering what happened during the financial crisis and how those banks blew up, and it was taking too much risk, lending people 100, 125% loan-to-value mortgages. Today, it's very different. If you want a mortgage, you have to put a down payment. And so it's understanding the risk that banks are taking and trying to find the best ones with the strongest balance sheets to invest in.
Perfect. Thank you. Dan, some growth stocks can seem expensive by many, especially those that are miles away from profits. What do you see in them? And can this really continue? And how do you find the next fever tree?
Okay, well, the first thing to say is that the vast majority of my long investments are very profitable and very, very cash generative. But value is always in the eye of the beholder. You just heard from Nick, he talked about banks which are perennially seen as cheap shares, and they have significantly underperformed. So buying something because you think it's cheap does not equal long-term compounding success. Many people tell me my shares are expensive, and they've been telling me that for years. Yet these shares can compound their earnings, they can compound their returns, their market capitalizations multiply through time. If you pick on shares that you'll know, like Hargreaves Lansdown, that's forever changed the DIY savings market for the UK. If you pick on phenomenally compelling differentiated industrials like Renishaw or Spirax-Sarco, they have compounded their market capitalizations over 15 years because they do something that other companies just can't replicate. They can't be disturbed or undermined by low-cost, aggressive Asian competition. They have incredibly high barriers to entry because they solve customer solutions, they're well capitalized, and they can finance that growth. And that gives them organic revenue growth far superior than their competitors. And that is why these great investments, which are always seen as expensive, can deliver and deliver and deliver. So I need people in the stock market to think of my shares as expensive on a 12-month view, really not appreciating and understanding what these companies can do over 3 years, 5 years, and 10 years, because the wealth creation going forward will be led by these differentiated companies with unreplicable asset bases or companies driving vast swathes of disruption across industries.
Thank you, Dan. Chris, why has capital gearing taken such a defensive stance? Do you regret not taking advantage of the strong markets? Why do you love US debt right now and believe inflation is coming?
Oh, that's a lot of questions. Right. I suppose the first thing to say is that we're trying to deliver absolute returns, and so at heart that means we're trying not to lose money. And so that inevitably means that we're going to be just that much more defensive than other people. We go about it in a fairly boring, conventional way. We just try a mixture of cash, equities, bonds, a little bit of alternatives, and we try and sort of mix all of those together in a way where we're really not going to lose too much money. And inevitably, that means that we do underperform when a bull market is in full flight. Of course, with hindsight, we would have loved to have had much more in equities, and we would have made much more money. But the reality was that by historical standards, even 4 years ago, most asset classes were expensive compared to their own history. And so we didn't feel that it was prudent to buy something that was expensive in the hope that it was going to get even more expensive, if that makes sense. Turning to your next question, why is it that we love US debt? Well, we love a very specific type of it at the moment. We've got 25% of our portfolio in TIPS, which are American inflation-linked bonds. And the reason for that is that as we look at the world today, we see that the world is grossly over-indebted, in our view, and that makes the financial system very fragile. And fundamentally, at heart, there is only one way to deal with the excess debt in the world, and that is something called financial repression. Now, financial repression is where central banks will keep interest rates substantially lower than the prevailing rate of inflation. Now, it could be that they keep interest rates at 3 and inflation is at 6, or you have inflation at 3 and they keep interest rates at 0. And if you do that for a long enough amount of time, you effectively rob the people who own the debt of the real value of that debt, and you get everything back into line again. And we're absolutely convinced that that is what is going to come. And in either of those scenarios, we'd expect inflation-linked bonds to do really well, and most other things to do pretty badly. And so that's why we have them there as our kind of anchor of our portfolio.
Great. And some fund managers focus on economics and politics first, sort of top-down approach, while others just pick stocks they like and think they can make money from bottom up, which can affect how they approach asset classes, opportunities, sectors, and geographies. Chris, I think your approach is different. You seem to adopt a top-down view. However, it's interesting that you specialize in a particular sector where you've had great returns, operating a sort of special sits investor in the investment companies sector, which is very much bottom-up, which is probably more of the approach of Dan and Nick, which hopefully is fair. What do you think works best, and why do you do it? And I also notice your new funds are more top-down, suited to sort of unit trust.
Yeah, I mean, we have a pretty idiosyncratic investment process, and it's a bit like the tourist in rural Ireland who asks for directions to Dublin, and he's told, well, you know, you wouldn't start from here. But I guess it works for us, and so that's what we do. Our top-down approach is that we essentially try and look at every major asset class around the world and try and work out what the prospective returns are for that asset class, how risky it is, and then we try and mix them all together. So, you know, there might be on the one hand German residential property, it might be UK small cap, and then it might be, you know, American inflation-linked bonds. But then once we've made that decision, we actually go and look at the investment trust sector and see if we can find interesting opportunities to exploit. So let's say we've decided we want to have 3% of our money in UK small cap, and we go out and see if we can find a trust that's trading on a discount. Now, a discount by itself is not necessarily interesting, but if you've got reason to believe that you think that discount will close over time, then that can deliver you an extra return. And so that's how we ended up with this sort of curious mixture of top-down and bottom-up. And, you know, well, it keeps us happy anyway.
Well, it's worked so far, yeah. Moving on to people and management and skin on the game as a sort of investment strategy. Dan, the key to success of many high-growth businesses is their management team. They are the drive, the focus, and the glue to keep it together. Nick, I know you focus on incentives for management teams in financial, but how do you both go about factoring in people, their ownership, and their remuneration into your investment strategies?
Yeah, it's a great question, and it's one that comes up often in meetings. You know, how are management incentivized? How much skin, how much money do they have invested in that business? But within our remit, actually, that's a risk. You go back to the financial crisis, Bear Stearns and Lehman's. I mean, is there ever a management team that had more skin in the game? And both of those failed. So for us, it's understanding the business model, what risks that bank or that insurer is taking, and that's the key, you know, to us. Undoubtedly, management are incentivized, and it's very rare not to be. But for us, it's understanding that and the risks that bank is taking and how that will perform in a stress scenario.
Thank you.
Yeah.
Great. Well, I think what I'll do is I'll link to two questions. One is around how important management teams are, and two, why do I care about fundamentals or a bottom-up way of investing? Yeah. So two things are closely interlinked. If I just pick on two shares to try and illustrate the point I'm going to make, Amazon and Fevertree. Okay, I'm sure everyone knows Amazon. I'm sure everyone knows Fevertree. Fevertree's probably gone up about 25 times in the last 4 years since it IPO'd. Amazon's gone up more times than I can think of. And what unites these two companies? Well, I'd start with the management team. I don't actually think Amazon will be anywhere near as successful and profitable as it is if it wasn't for the unwavering vision of its founder, Bezos, and more importantly, the depth and breadth of talent that he has built around him in that organization. It's one thing having a vision, it's another thing executing it. I've met many, many CEOs with great visions, and then it's all the value is being lost in the execution. Fevertree, again, an exceptionally differentiated and exciting consumer brand, obviously destroying the market share of its legacy incumbent, Schweppes. But it's been driven by a management team that have prosecuted that long-term opportunity, and they haven't been beholden to short-termists in the stock market. So I think when you find great management teams with a great vision, with a differentiated product, they can compound that success through time. Just think in the last 4 years when Fevertree's gone up 25 times or Amazon's multiplied. You've had the Italian banking crisis. You've had a Brexit referendum. You've had a proletariat uprising in France. You've had trade wars. You've had concerns over hard landing in China. All these huge macro political events that dominate media, dominate market commentary, keep the economists from Goldman Sachs gainfully employed. But ultimately, these shares have shrugged off all this nonsense and noise and have just delivered phenomenal wealth creation for clients.
Moving on to risk, there's so many ways of measuring risk, which is coming out, which is obvious today. Diversification, hedging, leverage, price, volume, liquidity, dilution. There's just so many measures of increasing it and reducing it. Increasing risk generally should increase returns over the long run. It's the common phrase I hear a lot, but looking at capital gearing trusts over and impressive performance over 30 years, there's little evidence that this phrase is relevant. But however, breaking it down, there are so many factors to play with from an investment strategy point of view. Nick, I know you struggle to get exposure in the listed market to fintech. So therefore, you have a position in Augmentum Investment Trust. Could you explain this, please?
Yeah, no, very happy. I mean, Dan obviously makes a very compelling case for investing in growth companies over value, and we do both of that. In financial sector, that's much harder to find. So technology is having an immense impact on the banking, on the insurance sector. When you think of mobile phones, payments, etc. So we get exposure through this to things like MasterCard, Visa, and so forth. But actually, it's quite difficult outside those to get exposure to other, startups, small, interesting businesses. So one way we have accessed it, there's an investment trust called Augmentum FinTech. It's investing in some of these startups, Zopa, Iwaka, Interactive Investor, and things like that. And it's a great way to get a diversified exposure to some of these, because you want to back the winners. The winners, as Dan was highlighting in some of these businesses, will make 5, 10, 15, 20 times your money. And you can offset the losses elsewhere. Whereas, having too much exposure to an individual one. So that's how we came to own that.
Okay. Keeping under the topic of risk, Dan, can you explain how you use CFDs in your portfolio to manage that?
Yes. Well, the first thing I was going to say is actually we've got some common ground here, because in my hedge funds I also own Visa and MasterCard. So there you go. You've got a value guy and a growth guy, and there's some common ground with two exceptionally compelling long-term investments. In terms of using CFDs to manage risk, really there's two reasons for using CFDs, contract for differences. Ultimately, I can manipulate my net exposure to the stock market. So if I'm feeling particularly bullish about the world, I can be more net long than a traditional long-only fund. Also, if I'm more cautious about the world, like I am now, I can have a net exposure less than 100, so I can have less exposure than many funds. That helps protect clients' capital and reduce the volatility of returns over time. The second, and much more interesting and compelling reason, is I can short shares. And people like me can't sit here and just focus on companies and go up 10 times and 20 times. Particularly in the world of small mid-caps, as you all know, there are many companies that go horribly wrong. 2 of my shorts last year went to zero, which is great for me because it's very profitable, but could be very, very disappointing or frustrating to those who actually own them. And unfortunately, there are many companies out there that can give small mid-caps a bad name. They have bad management teams. They have weak business models. They're being destroyed by regulation or through structural change, where they're just too commoditized. They've got far too much debt. They can't generate cash, and they sort of are very aggressive in their accounting treatments. And these companies are a problem for the stock market. And the advantage of having a fund or funds that can identify these opportunities and profit when they go wrong, I think is very compelling, and it really helps add to performance through time.
Okay, thank you, Dan. I know we're running short of time, so we've got to speed things through. And I know, Dan, you own Xero, the accounting software business, yet this is yet to make a profit and trading on a high multiple of sales. Why do you think that's attractive? And I also noticed you own Polar Capital, the asset manager. So what do you think?
Well, Xero has been an amazing investment. Xero is an absolute leader in accounting software. Created by an entrepreneur in New Zealand over 10 years ago. Very disruptive. Ultimately, in the UK, in the US, the vast majority of small, medium enterprises are using spreadsheets to manage their accounts, which clearly is something that can change very, very quickly through time, through the provision of software that makes their lives easier. Hence, this company has seen annual recurring revenue growing at 45% per annum. Now, this is a very important year for it because this year is the first year it'll make a profit, okay? The price to earnings metric, i.e. value incomes and profits, is a great barometer of value, like 9 times in 10, but 1 times in 10 it is an absolutely useless, redundant metric. You never would have bought Amazon, you never would have bought Fevertree, you never would have bought Xero, you never would have bought Netflix, because sometimes companies have to scale quickly and they have to invest all their profits in creating that scale at speed to take market share. And so the key thing is not caring so much about what they're valued on 1 year, but how quickly cash flows materialize and grow over 3 years and 5 years and beyond. And that is the key in differentiating between those that are sacrificing near-term profits for growth and their ability to turn that profit and cash and see it inflect in the future. As for Polar Capital, asked Nick, but in a world where asset managers are consolidating and there's a stronger emphasis on just growing assets and pricing powers being eroded, Polar Capital is an incredibly attractive business model because it effectively has a platform that attracts star fund managers who contain pricing power, and generally they are more niche strategies focusing very much on alpha creation for clients, and they can keep diversifying that through time and really carry on seeing very profitable growth in the future.
In a couple of words, Nick, you could own Xero. Would you buy it now?
I think you've had the buy argument here. So we're spoilt for choice. We invest in the largest sector globally. Key for us is we're an income and growth vehicle. Yeah. We have to balance that income requirement. Some of us need income.
Yeah. And Chris, imagine this isn't the sort of thing you'd look at, but I'd like to know when a stock is attractively valued?
Do you know, we really don't actually. So we never try and make an assessment as to whether an individual stock is expensive or cheap. What we try and do instead is look at a market as a whole and see if that is expensive or cheap. And the reality is that you do come across kind of very talented individuals like these guys that are able to consistently pick winners. But those people are very few and far between. But actually, the things that go into what equities, say in the United States, are going to return over the next 10 years, that's pretty easy to understand. And so, we try and keep life easy for ourselves. So that would be a no from me.
Great. We are running out of time. I did want to ask a quick question on and it's relating to Brexit, and it has to be asked. But given what's happening, if you were going to pick a stock or a fund other than your own, what would you pick for a hard Brexit and for a soft Remain outcome in literally just two words? Sort of.
Okay, well, I'll go first. hard Brexit, I'd expect sterling to fall. That's not a controversial view. And I'd expect interest rates to fall. So I would choose long-dated government bonds that are overseas. And for a soft Brexit, I would go for UK small and mid-cap.
Thank you. Dan?
A hard Brexit by the Morten Investment Trust. Soft Brexit by the Morten Investment Trust.
I mean, hard Brexit, you obviously have to buy Chris's capital gearing trust. I'd say a soft. Well, I'd agree. UK small mid-cap focused on domestic companies.
Well, thanks, guys.
Great.
Just in conclusion, I'm going to wrap up. We're running short of time, and I'd love to actually go on for ages because it's just the amount of expertise these guys have is phenomenal. In conclusion, the future is unknowable. I'm just going to give a couple of closing points, which I think hopefully I've extracted from this. In conclusion, the future is unknowable, but investing for the longer term helps and diversification. Try and avoid losing money. If the value of your portfolio goes down by 50%, you need it to go up by 100% to get back to where you started. There is a lot of focus in interest rates, and interest rates are at rock bottom at the moment. That means more than ever, it's important to keep costs down, keep trading costs to a minimum. Think about tax efficiency, ISA allowances, SIPs, junior ISAs, things like that. Even if we could identify what is the one best thing to buy for the future, it will still give a bumpy ride. So will you psychologically be able to stay the course and stick with it? Look for champions who align with your lines of thought, and maybe those who don't. Place your money with people and companies and funds who have integrity, who you trust and have skin in the game. And finally, focus on things you can control. Before I wind up today, just a little bit of PR on QuotedData, but it gives you tools and an extra layer of help on companies, investment companies, funds. So do use it. It's free. It's paid for by the industry. We have also written on funds managed by Dan, by Chris, and Nick, which you can take away, and it's on our stand. And we have a selection of other recent notes, etc. Nick will be here after the talk. So if you have questions, do go and see him. Dan will be heading now to the auditorium. So I expect that would be very popular, so do follow him there. Chris has a filming session now, but will be free at 12:15 at our stand, the QuotedData stand, which is over there, for 30 minutes if you want to explore absolute return strategies and how they got to that #1 spot over 30 years. Otherwise, I recommend seeing some other great talks that are out today. Thank you so much for coming, and thank you so much to my panel who have given up their weekend to be here. So could you kindly give them a round of applause? Yes, thank you. Thank you very much.